And then I was trying to get us on Facebook as well. So
Sweet. Looks like I got a suntan with this light, but that's okay.
it's all good. At least one of us is getting some sun.
I know, right?
I'm the opposite. I have a skylight here, and so it makes me look like I'm washed out and white.
Yeah, and I'm
whiter
pretty
than I
sure
already am.
I'm pretty sure I'm as wet as you or worse. So yeah, I don't think I've had sun in a year, but let's see. I'll take it.
That's funny. Cool. All right. So how are you doing today?
Doing good. How was your weekend?
Good. It was good. So.
Great. Yeah, it was a busy
Nice
weekend overall. Did you do anything fun?
I mean, we cooked out, and that was about it. So.
Still cool. Yeah, same here.
Yeah.
Little barbecue.
Cool. All right. Well, we have a couple people on, so welcome everybody. And then I know there was a couple of people that had already reached out, and they were like, "Please send me the recording." So.
No worries.
Yeah, so I know it's always hard, like, trying to schedule stuff, because I know everyone's schedules are crazy, and then a lot of people have kids home and stuff now, so, which I do apologize. Mine are around here too, so hopefully they don't make an appearance, but we'll see.
You never know, right? Well, exactly. No, and I think Tuesdays sometimes become a new Monday after holidays. You just never know. Like today,
for sure. Yeah.
This morning I had like 100 calls, so it's crazy.
I know. Well, and yeah, we had planned today because Tara was supposed to be joining us, and then she ended up having to go and do a final walkthrough with somebody. So it's just us for today.
No worries. All right, do you want me to just get started then, or how you want to do it?
Yeah, sure. I'll pull up. I'll share my screen real fast so we can see. It's like our info here, and then can you see that now? So
yeah, it looks awesome.
Let's welcome Dante Miller. Thanks for joining us today.
Awesome. Thank you for having me.
Yeah, so I guess if you just want to go ahead and tell us a little bit about yourself, and then we can get started.
Sounds great. Well, my name is Dante Miller. I've been a mortgage lender or loan officer or account executive since 2000. So it's been about 20 years. Basically, I think one of the things that got me started in this line of work was I started out as a realtor in 1999, and a lot of the times my clients weren't being able to be helped. I think a lot of times, especially with newer agents, you might have buyers that don't have the same financial background as maybe some advanced agents might get. You might get people that don't have long job histories, don't have greatest credit history, don't have maybe everybody in the family that has enough credit or income or provable stuff to get things going. And so for me, I found that I needed to be able to help what I could say regular people. May not be regular, but for me it was regular. Because I grew up, semi-poor or whatever, and didn't have a lot of money, and my mom had a difficult time, so she had to do special programs. So either way, my normal clientele, even to this day, tends to be people that need something other than maybe the regular person that has 20% down and has perfect credit and could just or buy a place cash. So that's where I kind of started, and that's what kind of got me focused on zero down lending more than anything else. I do low down, zero down, high debt ratio stuff. Obviously, I could do everything that's normal as far as someone wants to put 20% down and get a house they can. But normally a client will call and say one of three things. One, I don't have a lot of cash to put down, or if I do, I'll be broke, and the lender doesn't like that.
Right.
Two, my credit is not on point. It's not in a 700 range or 800, so I don't have the credit score to move forward. Or three, I have income issues, and maybe I'm not getting approved for enough house or any house. And so we'll talk a little bit about how all three of those things kind of get tackled with a variety of different programs.
Okay, cool.
So let's talk about first just naming off the different programs. So there pretty much is about 5 or 6 total programs in the state of Texas, and we'll include one extra one for the city of Corpus Christi that we can use. Okay. My favorite, and I'll start with that, is TDHCA, which is the Texas Department of Housing and Community Affairs. The benefit of this program over some of the others is it basically mirrors FHA guidelines. And so what I mean by that is when somebody goes for an FHA loan and they apply at a bank, or any lender they apply at, the lender they apply with can and usually does add rules to whatever they're willing to accept with FHA. So FHA may say, or does say exactly, that they'll go down to 500 credit score, but most banks or lenders won't go down to 500 credit score, even though FHA says you can. And that's because they pick their risk level, okay? Well, TDHCA, although it doesn't go down to 500 credit score, it does allow all the other parameters. So as a lender, if I can get FHA to say yes, then TDHCA will say yes. So a good example of this would be if somebody wanted to be approved up to 150,000 and all the other banks were saying they're approved to like 120, TDHCA, as far as zero down goes, they would allow them to go with a program that also adds a mortgage credit certificate income to them, which we'll go over in a sec, and go up to 56.997 debt ratio, which is the highest usually FHA goes. So when you combine those things, somebody can get that home. And now a counter argument is maybe they shouldn't buy a $150,000 home if they can't afford one. But I think what most of us don't realize is not all income gets calculated. Can't always use overtime bonuses, spouse income, self-employed income if not for long enough, kids that contribute to the family. There's just different things that you can't always add. And sometimes people have enough income, we just can't use it all. And it's really difficult if you need 3 bedrooms or 4 bedrooms and you're only getting approved for a house, they're only gonna have 2, or you really want to be in a certain school district and you can't. It's difficult. So THCA is great on those. Now, also what's good about it is it has lower interest rates than the other programs. So I like that as well. The negative is they give you as a gift the down payment. So give you the idea is say I'm buying a $100,000 house and I'm going FHA with 3.5% down. That means I would normally need $3,500. Well, they're basically going to loan you that money. So you'll get it, but you have to pay it back. No interest, and you don't have to pay it back till you sell or you refinance, but you do have to pay it back. So if I bought a home today and then I sold it a year from now, I got a free gift in a way of $3,500, but I had to pay it back. So it's not bad. Overall, it's usually financially best because if I have a lower interest rate, then it saved me money. But in certain times, like I'll get people all the time that they want it, quote unquote, free money, and there's other ones we'll talk about that forgive that loan over time. The other thing that's there's no other real huge negative on it, so that's the main negative. But the other thing that's kind of cool is there's a program called Mortgage Credit Certificates, which has been around forever. We used to have it in Nueces County for like 25 years, but people don't tend to take advantage of it. The Mortgage Credit Certificate doesn't have a credit score requirement. It doesn't have a lot of requirements except for you can't be over the median income, but it allows you to get up to 25% back of the interest you pay on your house every year that you stay in your house. And so this is only for first-time home buyers. Both programs are. So TDHCA and this one means you can't have owned and lived in your primary home in the last 3 years. So you bought a home 4 years ago, you're fine. But if you sold your home last month, you're not. But the thing is that program alone, almost everybody should do, because you can get over $2,000 or up to $2,000 a year every year for like many years into your home, and it's almost like free money.
That's pretty cool.
It's the coolest thing.
Everyone likes free money.
I know they do, and the thing is you can do your normal loan, you can do your VA loans, your conventional, your FHA loan, not even do down payment assistance, and get free money. You can't use maybe a local credit union because they don't like to use these programs, but you can use any lender that's participating with this. But it's one of the better programs over any of the down payment assistance because you can recoup your down payment even if you paid it yourself in a few years.
Yeah, that's neat.
And how it works is at the end of the year, you file your tax return and then you basically click a box that says MCC and you fill in the amounts from how much you paid in your interest that year. And you calculate 25%. There's two different options, a 20% or a 25%, depending on which is beneficial. So 25% gives you more money now, but less money later. And 20% gives you possibly more money now, especially on like really expensive purchases. But all that stuff we'll figure out later if you're doing MCC. But the good thing is just remember, hey, what's MCC again? I don't understand. And then we'll go over it. Now, the other programs many people have heard about is called Seth. I think it's just because it's easier to hear the word Seth than TDHCA. And it's fine. Seth itself is still good. The benefit of Seth usually is they can give more down payment assistance than just the 3.5%.
Okay.
So for some people, say they're going conventional with 5% down, or even if they had to put 10% down to get their loan approval, they might be able to get up to 7% of help. So in that scenario, we definitely like the Seth. And there's two programs. There's a Seth and a Seth Gold Star. Typically, Seth goes within a lot of lenders use Seth, and a few of them are allowed to use Seth Gold Star, and they just have slightly more down payment assistance or more lenient guidelines on the Gold Star, but not everybody can do that one. We have both, but I tend to just use the Gold Star since I can. So
Okay.
it doesn't make sense for me yet to use the other one, but if it goes away, then we got that.
Yeah.
And the other benefit is you can, it's forgivable over time. So if I bought a home and say $100,000 home and I got $7,000 in assistance, it would slowly go away over the next 8 years. And so then I wouldn't have to pay it back.
Okay.
So I definitely like that more than paying it back.
Right.
But yeah, exactly. If I could, that'd be awesome.
Yeah.
But the interest rate on it would be higher, so I've got to calculate that difference.
Okay.
So,
Figure out.
yeah, if I'm spending $50 more a month for my same house, it may add up that I ended up paying it back anyway. So
Right.
who knows? Well, you got to do some advanced math and guess how long you're going to stay in a place. But the one real good benefit is that if I'm going conventional, oftentimes I might need 5% down because not all borrowers can qualify for a 3% down conventional depending on their income and what they're buying.
Okay.
And so that doesn't exist the same way with TDHCA because even if you do get the 5%, there's only so much a seller can help with closing costs on conventional, usually around 3%.
Right.
So you might need to actually get the full 7% to help get it closer to zero move-in. A lot of my people want to do zero down, which is great. But when they think zero down, they think zero total. And that's good. You should want that. But like buying a car, your down payment may not be the same as paying your tax, title, and license or paying your car insurance. There might be 3 different numbers. And we want to make sure that at least if someone's going zero down, that they don't get to closing and be like, hey, where's your $5-6 for closing costs, taxes, and insurance?
Yeah.
Like, no, I'm doing zero down.
Right.
Like, yeah, I get that on VAs sometimes, or at least used to. And then I've even had a call the other day, like 2 years ago, from another agent, and we're at closing. He doesn't understand. We did zero down and everything, and they're telling me to bring money to closing. We even asked for closing costs, and I was like, yeah, you got to be careful with those, especially on phrasing. Even if you said, hey, just pay my closing costs, technically for a lot of loans, if you escrow in your taxes and insurance, you will have prepaids. Yeah. And so you can have all your closing costs paid and still need money.
Yeah. When I sold in California, we'd actually put on the contract, like, pay for closing costs and prepaids and everything. So
yeah,
California had to be very specific.
Yeah, well, and every now and then too, I'll get people, they'll write it into the contract so they'll pay all closing costs. But again, even if you write it in, it still can be interpreted differently. And then, but at least with you wrote it all in. And the only other thing too is that technically a lender could keep raising their closing costs. So there's not a specific number, but usually it's more regulated now. But when I started, if you wanted to charge $10,000 in closing costs, you can charge it if someone's willing to pay it.
Yeah, I think things have gotten a little bit better now, but
Yeah, they have. Well, and all these down payment assistance programs, they cap how much you can charge. So they're almost exact same fees from one bank to another. So it makes that a little bit easier. I
okay.
know at times people might say, well, don't go to that lender. They're more expensive or they have higher rates. Well,
Yeah.
not if they're doing this. It's the rates can be found online. So it works
Okay,
out pretty
cool.
good. The other one that's used, I don't use this one very much, but it's one to keep in mind, is called TSAH, which is actually spelled TSAHC, Texas State Affordable Housing and Community Affairs, something like that. I don't remember the end on there. But the benefit
All
of
these
this one,
acronyms.
I know it's so weird. That's why they don't like market as well. It's like
Yeah.
I used to do fundraising for like tree pack, and tree pack is such a tough word for people to be all excited about. So it's so hard. I was like, if they would just think of a cool name, we could raise more
Right?
money.
Yeah.
But on the TSAH, basically, if you've ever heard Homes for Heroes,
Yeah.
the main Home for Heroes down payment assistance one, there's another one that's more of a somewhat marketing where agents chip in money and stuff. But the Homes
Right.
for Heroes down payment assistance, that's where this one is. And what it does is, if someone's a first responder, medical field, fireman, stuff like that, they're gonna give them the down payment assistance similar to TDHCA or even Seth, but they'll allow a higher income level than the other programs will for those first responders or stuff. So
Okay.
so if I have a nurse making 80 grand a year, I can't go the other two programs well. I mean, um, technically Seth might working on a conventional, but if I had a spouse on there, no. But this will allow her to go get it the same down payment assistance just because she's in the medical profession. So
Okay.
it's not a huge difference. It is forgivable as well, which is pretty good. And the rates on that one are usually slightly better than the Seth rates, and similar to TDHCA. So maybe not as good, but similar. And on all those programs, I might even do Seth or Seth Gold or TSAH and add on the TDHCA MCC. So it's a separate program that you can either do together or apart. So most of the time I like try to give my first time home buyers all their programs. But on some of these ones, like on not on any of these ones we talked about, on the next one's coming up, you don't have to be a first time home buyer at all, but you can still add on other programs if you are. Those ones are the normals. Now here's some of the abnormal programs that most people won't know that much about. Okay. So Chenoa, which is CHENOA. So Chenoa basically
Kind of sounds like Chernobyl.
I know, right? It has a weird name, and I believe it's basically some Indian reservation type backed fund or something like that.
Okay. I've done one of those like years and years ago.
Yeah. Well, there's the cooler
Yeah.
ones where you actually get like a grant from one or whatever. That's pretty cool. This one isn't as cool. I think they've modified it or it's different.
Okay.
What happens on this one that's cool about it is it's for high income earners. So there's no income cap.
Okay.
Um,
Nice.
you don't have to be a first time home buyer.
Okay.
You could basically, most anybody could qualify. I mean, all the programs, including this one, do require a 620 score at this time. So, but
Yeah.
if somebody has 620 score, they can actually qualify for this program. And it basically gives, let's say, you make great money, but you just sold your home and you lost money selling your home, but you really wanted to buy another home, but you really just don't have any money saved up, you can get a house. So it's good.
Yeah. Okay.
And I do have several people, even when they do have money for down payment, still do this program. The downside to it is it's expensive in the sense that it's higher fees without the ability to get more than 3.5%. So oftentimes I might have to ask a seller to pay more seller concessions than normal. And I've had many times where I've done and talked to agents and said, hey, we need to ask for like the full 6% seller concessions. They're like, what? That's ridiculous. It's a $200,000 house. We have
Yeah.
$12,000 in closing costs. And everybody know, it's not just closing costs, but
Right. Yeah.
for this program, they'll technically charge 1 or 2% discount points. It's just a way for the bank to make money, and the loan officer doesn't make money. So usually the discount
It's
points.
not me making the money.
I know, it's like, hey, I can't make a single dime more whether you do this. I would rather people do a regular loan with 5% down or whatever. But that's okay. And that's another reason, just so y'all know, why don't all lenders offer all these programs? Because they don't pay well. They pay very poorly. Now that being said, I'm pretty sure most agents have taken a deal at lower commission or split it with a partner or referred it out as a friend. So we can make lower money and be okay. We just got to know up front. And so here we do know up front is that, hey, we're doing multiple different loans with down payment assistance that don't pay a lot. And so we have to do a bunch. And if you wonder why they maybe take longer to close or why people aren't as excited about them, or they're a little bit more tedious on paperwork, it's just because it doesn't pay enough. So you can't really like hire extra assistants, and you can't like, you know, you do a lot of fancy advertising or anything like that. Anyway, but on back to the Chenoa, the extra issue about it that's difficult is the higher interest rate. So it's higher than even the Seth. So technically, if someone's doing it, I'll like compare out. Example, let's say I could give somebody a 3.25 today. This one might be at a 5.25. So if someone's buying that $200,000 house, you know, instead of paying say $1,600 a month, they're paying $1,800 a month. They still don't have the money, so it's still better than nothing. And I'll oftentimes with them use a car analogy is, yeah, there may be these 0% interest rate loans for somebody, but you probably bought your vehicle without paying 0% interest. You just didn't always qualify for that, but you still got a car.
Yeah.
If you really want a house, it's better than paying rent, which is 100% interest usually.
Right.
So we said, okay. And at least it's, you know, it's only 5. It's not like it's a 10 or adjustable or whatever. So there's reasons. Just mathematically, it's easily to prove you shouldn't probably do it if you don't have to, just because $200 a month in interest adds up quite a bit.
Yeah.
And you would then, you know, if you stay there 5 years, it maybe not the greatest financial decision if you had another choice. But if you don't, it's okay, and that's fine.
Is there like any prepayment penalties or anything? Could you refinance into another loan later on?
No, you can refinance into another loan. They do allow that. I think they require like a 12-month waiting period, so it's not the end of the world. So you get into a 12-month. I find that the only issue that happens oftentimes is that, especially if you have that second lien on there that they gave you that isn't forgiven yet, you might not have any equity. So then you might sell. But if that's a great plan, is let's say I found the perfect home. So normally the idea of this loan in my mind is I wasn't ready to buy, but the home I really, really, really want happened to hit the market, and I don't want to let it go.
Yeah.
So I want to grab it, even though maybe I didn't prepare properly, but I just didn't expect this timing to happen. So if I get it now, I'll have enough money 6 months or a year from now or whatever to actually have done my down payment, and then I can refinance and do it, but I don't want to lose out on that particular home. It wouldn't be just maybe any home for any reason, unless I just, you know, again, either found the perfect home or I just wanted a house and I didn't care about putting down payment. I had 2 people recently, they had 10 grand in the bank, but they wanted to use the money for furniture and other stuff. And they made really great money, but they just didn't want to use it. Even though I mathematically showed the difference, which I don't have to. I could just go for it, but I just thought no. But they still move forward. I wouldn't be surprised if one or both of them already refinanced by now, though, because the rates have dropped so much. But on the Chenoa one, it's not that hard of a program. It doesn't require any special qualifications. So again, if someone's a first-time home buyer, they might get a slightly lower rate, or they may make the second lien forgivable over like 10-year cycle. So there is some benefits to being a first-time home buyer. And again, we could stack that MCC with it if we wanted to. So there are some cool stuff there. Other than that, those are the main 5. The only other one that we have here in Corpus that most of us know about, but maybe we don't use, is the City of Corpus Christi grant. It basically, it's a couple of reasons why we may not use it or know about it as much. It's been difficult to work with at times, just because it takes a long period of time to process, and it has a lot of rules. One of the major rules that's somewhat changed lately is its debt to income ratio is it requires like a 32% for the house max and a 45% total max. So it makes it more difficult to qualify for. Now, let me give you an idea how that works. If I'm making $1,000 a month, that means I can spend $320 on my house, but $450 on my total debt. So the hard part is the city requires you to be lower income. So you always got to be lower income to do it, low to low medium. And it goes on how many kids you have. So let's just say there's 2 people in my family. I think there might be a $40,000 income situation. Well, if I did that, that's about $3,300 a month, and then that means they're going to allow me to spend about $1,500 a month on my total debt and about $900 on my house. So finding that configuration where somebody doesn't have too much debt, too much cars or whatever,
Right.
and they're willing to buy a home that has that's low enough pricing in that to make it work is difficult. Now, sometimes we luck out in the sense that as a lender, we may think they don't qualify, but the city will, because they will count if the teenage son works at McDonald's or something, they'll count that income in there. On the bad part is if that income puts them over the limit, they won't give them the loan, or they won't give them the grant. So it's hard to shop for a home with a bunch of ifs, ands, or buts. And this one has even more than the normal. And it's hard to be really low income and good enough credit to get it. So there's not a credit score requirement per se, but A, you got to find a bank like ours that may go down to 500. B, that when somebody has that low score, they would then be harder to get automated approved or approved for the loan. Most of the time it's difficult to get a city grant on there because just like the down payment assistance ones, the city grant creates what we call a second lien. So when anybody uses any of these programs, they're at a higher risk because they have little to no equity built into the place. And on the city grant, since they can also use it for closing costs, they actually are negative equity. And so when you're negative equity with a lower credit score and lower income, it's hard to get the bank to say yes, but it's almost the only way you can get it. So, but it's a great program because it gives you 10 grand down, and I think it's up to $7,500 now for closing costs and prepaid. So if somebody qualifies, and it happens, you find out a person that's lower income, but they pay their bills on time, and they want a house that's modest, but in good shape without any weird add-ons, because City Grant does check for code enforcement violation stuff. So you get it set up, then it works out really good. And so even though it may take 2 to 3 months to close, if you find the right scenario, the buyer can have a great deal. So it is good. I've done probably maybe 120, 130 of those over my last 20 years. And at times they were easier than they are now, but they're still good. They were less money than they are now. So, but those are your big ones. So those are the main ones you're going to stick around with. I do know that there are, we don't offer this one, but it is one that I refer my clients out to other banks on, which is like called a physician loan. Basically, if someone's in the physician or medical field and they're a higher income earner, they may be able to do what's called a $500 down program, as long as they have a 620 score and they have a 45% debt ratio. What I like about that for at least clients, even though it doesn't help me at all, it helps y'all's clients. Is basically it does allow up to 6% seller concessions. It has no mortgage insurance, and it's just $500 down. So it's really awesome program. I believe American Bank is the best one to go for that. And also BBVA Compass has it. I haven't ever had any luck working with them yet, but I know they're working hard on it. So hopefully, I know just they used to take a couple months to process stuff, but maybe they've gotten things better. But other than that, I think that's most all of those things. Is there any questions you might have or think? Or
well, we had our frequently asked questions, which some of them you probably answered, but
go for it.
We'll go ahead and take a look what they were. So let's see. Well, can you really buy a home with zero money down? Obviously you can.
In fact, sometimes if we do it just perfect, you'll get your earnest money back at closing, so you can technically feel like you're no money out of pocket. I think the one thing that tends to happen with our bank is we do make them pay the appraisal fee up front in case it doesn't work out, just because sometimes it doesn't always go as planned. Appraisals can come in low or repair issues. So you may be out $600 overall.
Okay, cool. And I think that's pretty, it seems like it's more and more common now that you're having
used to be we would do them all ourselves, but I think 2 years ago, maybe 3 years ago, I lost about $8,000 just in appraisal fees on my own.
Oh my goodness.
I was like, man, that's a marketing expense.
Sheesh. Goodness.
But so on the number 2, the explaining the qualification process, that's a great question. So it used to be back in the day, we would just pull credit, hear them tell us what they make, and basically say, hey, good,
Yeah,
That's
you look
good. You're
great.
good to go. No, I can't believe it. At one point in time, I think I used to only pull one credit bureau and
Oh,
just hear them
wow.
tell me what they make hourly and be like, okay, calculation and go shop. Um, and it's still difficult now. I just want to remind everybody when a lot of times, if I've been doing this a long time, and there can be times where my clients tend to seem like they don't close on time and maybe they want to blame me or the bank or whatever. Do remember that when you are doing zero down or low down programs, you're usually dealing with people that don't have a lot of assets. And if they don't have a lot of assets, they may not always have the best credit situations or the best job situations. So you really don't want to balance that on, hey, let's close in 30 days. Let's do this quick and easy. This is going to be
Yeah.
so no problem. Because just like a house, if a house has some repair issues or some quirkiness and you're worried about its appraisal or whatever, not all houses are the same and not all people are the same, even though they could be doing the same loan or in the same neighborhood. And so
Yeah.
my point of that is that the normal process will work, um, but there's a balance between speed, time, energy, and paperwork that's difficult. So for example, what typically happens is nowadays I oftentimes will have my clients do an online prequal just so I don't have typos or make judgments on their ethnicity or locations or how long they've been on the job. I try to do that more to be better with it, even though clients tend to have issues remembering how long they've been on jobs or other stuff, which is fine. But they'll
Yeah.
usually do that, and I'll pull all three credit bureaus. And if the credit bureaus are under 620, it doesn't mean they're not going to be able to buy. They just may not be able to buy zero down. So oftentimes what will happen is that I'll analyze it. I have a credit boosting scenario thing that I can run on different bureaus to see if there's any easy credit boosts that might get them into a 620 or higher so they can do more stuff.
Okay.
Um, and especially if I can get them at 640 or higher, I might be able to even get a higher debt ratio right now. Little things have changed since the pandemic breakout.
Yeah.
But once we get that initial pre-qual, the next step is to try to get financials, which is usually the last 2 years tax returns, W-2s, if they're self-employed, no W-2s, of course, but a month of pay stubs, and a month of bank statements, even though most of the time I don't use the bank statements because the zero down products, but it is good to know if there is any funds available. I start with that to analyze where their income might be at based off of those numbers.
Okay.
Now, after that, what we try to do at the same time is helping them figure out where they're at. We try to get a new list of stuff which asks for like 401k stuff, ID, stuff like that. And we try to get all that into a pre-processing department that we use with our company out of Houston. And what we have them do is try to upfront verify employment, because the hardest thing we actually find is that no matter how much money you actually make, we don't go by what you make, we go by what your employer says you make. And I hear this all the time is like, I get overtime every year. Well, if their employer uses a thing called the work number, it may not break down their extra income. It just calls it other income. And
Mm,
if we can't prove if it is overtime or not, it makes it difficult. So I,
gotcha.
it's hard to do fast pre-approvals anymore unless we're just doing base income, stable job history, every paycheck looks like 40 hours or whatever. But it is still possible, and we sometimes will even pre-approve without having everything in on a lower level basis. Like somebody might, I might tell them, hey, once I get everything in, I might have you up to 200,000, but right now you're only safe at 150 because I don't know how your stuff's going to break down. If I
Yeah.
can prove the 2-year history of this and stuff. It used to take a few hours to do it properly. Probably takes a few weeks, depending on someone's work history. If someone's worked 6 jobs, it could take us a couple of weeks just to get all the employers to respond. If someone's been on the same job and we can use the work number, we can sometimes do it in a few minutes. So,
It
but once we
depends.
have that, yeah, and those are the 3 things you basically need to think about: is credit, obviously, income, and assets. And the assets is the least important. A lot of people think credit's the most important, but credit can be fixed. I don't necessarily agree with credit repair per se, because I used to run a credit repair shop and it doesn't work as a high enough percentage level on scores. But with a little credit boosting tool, normally getting a credit card or paying a balance down or off, somebody can get where they need to be within a few weeks, few months, if they really are in a position to buy.
Yeah.
If somebody, like I've had a person with like a 540 score and people will be like, well, their credit's not good enough to buy. And it was only because they just had payday loans that they've gotten paid off every month. They never paid late. They just didn't have anything else. I've
Yeah.
had other people with a 540 score that paid their bills late every month. Well, the one that pays bills late every month, we probably shouldn't add another bill.
Right.
But and they can say, well, I pay my rent on time. And like, yeah, but once it becomes a mortgage, what if that changes? I don't know. We don't want
Yeah.
to take that chance. But like on the other one, I got him a credit card, or showed him where to get a secured credit card, and his score went up 140 points in 1 month.
Wow.
Yeah, so it went
Yeah.
from 540 to 680 because he was just missing. It's like trying to get into college, and you're like, hey, I'm going to take the ACTs or whatever, but I'm going to skip the math portion, but I'm going to ace the rest. Like, dude, it doesn't matter. You got to take all 3 portions or
Right.
whatever.
Yeah.
So there's parts on the credit, but credit's fixable. Income is my hardest one lately, ever since the crash of 2008, where we kind of did away with these stated income programs.
Right.
It's been
Yeah.
really difficult to get my self-employed borrowers, because most of my
Mhm.
realtors know, and I know
Yeah.
for my self-employment as well, is that if I can write it off, I want to write it off. I don't want to pay IRS taxes
Exactly.
on that
Yeah.
money. But if I write off too much, I can't afford the house that I even would normally live in fine. And
Yeah.
it's a delicate balance. So on those situations, there's either A, we try to balance around a tax return time, try to catch them before they file, maybe don't write off as much. B, they switch to being a W-2 employee of some sort, or C, they have to put a large amount down and do some unique program with a higher rate or whatever. There's programs for it, but it's just harder to get around. So my
Yeah.
self-employed ones are always the more difficult. Um, and then, or if somebody just started a commission-only job, even if they're not self-employed,
Yeah.
if they don't have a history of it, it
Mhm.
could be difficult. I even have a physician right now who was offered a great paying gig, but it's 1099. And he's like, is that going to affect me? I'm like, yeah, well, keep
Yeah,
your
it
house.
will.
Yeah, I know. It's like, but it pays so much more. It's like, prove it. I can prove it with my first check. No, you can't.
Yeah.
You won't be able to prove it till I see the end of the year's tax return after whatever expenses you write off.
Yeah.
And then I compare that to the next year's end tax return. And then yours is even going to be less this year because you would have started halfway in the year. So, but that's basically how the pre-qualification works. It's just the pre-qual, the collect some financials, some pre-processing research on more financials, and then a pre-approval comes out. Even with all that work, there's still things that can come up along the way. Sometimes, I
Yeah.
mean, there's like 1,000 things, and especially the more credit challenged or income uniqueness or asset issues a person has, the more difficult it is to feel and check all the boxes. I do
Yeah.
notice that we're all human, and it's like if I walk into a house and I notice there's like mold on a wall or something like that, I might be really focused on the mold and I might miss that the AC closet door doesn't shut right or something. I mean, it's minor, but it may be something. It's hard to catch those things when you're looking one way versus the other. And you've almost got to be a magician sometimes. Cause like I said before, I literally could pull one credit bureau, talk to somebody, find out how much they made hourly and pre-approve them. And I would close those people. I mean, when I worked at Countrywide, we would close things like in 2 weeks nonstop,
Oh
and it was
yeah,
a little
country.
bit
I
more.
remember
Oh,
Countrywide. It was like they were easy. They approved anybody and everybody. It was like,
I know.
of
It's
course,
like I
that's why
couldn't
they were
compete
one of
with
the first
them.
ones to go under.
Exactly. I couldn't compete with them, so I had to join them. I was working like 30 loans a month, and that was my first month in there, and it was a ridiculous volume.
Yeah.
But yeah, of course, when you're going that fast or that carefree, I get it. It goes under quickly. Here, though, the problem is that you got to balance. As a real estate agent, you got to keep your clients motivated and moving. And so, not all agents, but a lot of times as an agent, I might show a house first or find a place or somebody wants to buy a place and they're not pre-approved because it's
Yeah.
much easier to get people that want an object or product to then try to get the money for that object or product than it is to do the right way, which is get
Get
approved
approved
for
first.
money for a product before you know what that product is.
Yeah.
But it just doesn't work that way in houses too much. I mean, even not on our first time home buyers. Other people will know, especially after history of it, is I get calls nowadays. Hey, I was thinking about buying another home or doing something. But I want to start here first because if I can't qualify, then what's the use?
Yeah.
That'd be great. But you know, it is. You put a sign in the yard, do an open house, get people walking in that open house. Never bought a home before, but they'd love to buy. What do I need to
Yeah.
do? I want to buy this house. Well, you can't spend a couple weeks trying to buy that house, especially if it's a good deal or whatever. You need to be able to make a decision and make full contracts quickly. It's tough
Mhm.
because the quicker you move, the more risk you have of miss something. but also the more difficult it is to keep a client interested. If they take 2-3 weeks to pre-approve them and the house is gone, you don't have an interest. So I get that. So I try to do a leverage based on both, where I'm like, yes, I think this is where we're at based off of all the good knowledge that we have. It could be more than that, but I won't know until we get more stuff done. But that's kind of how that pre-qual works. So.
Okay, cool. All right, let's see.
See what other questions we might got on there.
All right. Is there a minimum credit score and another income limit? So you kind of touched upon this.
I did. And on each program, there is going to be, besides the city grant, a minimum 620 score and maximum income limits on all but the Chenoa. So Chenoa is the one we didn't have the max income, but all the rest of them are going to cap. They vary depending on county and people in the family, whether it's 2 or 3. It doesn't really go more than that. But yeah, usually like on TDHCA requirements, I think it was around 66,300 as a family, but it might have changed this year. But anytime we have someone come in and we check it in, the one kind of unique difference I would say is, let's say I have somebody that is on track to make 80,000 this year, but it's due to new bonuses or added commissions or stuff like that. If the underwriter isn't going to use it, say they're lowering their income because they don't have a good 2-year history of it, or we couldn't quantify it, sometimes that helps me out and actually gets me my down payment assistance program. EHCA, whatever. Some programs go by what the underwriter uses. Some go by the whole family, like the city grant, whether we use it or not. We would never use the kid not on the loan working at McDonald's, but they will. So
crazy.
It's not like you could go and look online, find out the income thing, and be like, see, this is where you're at. You could think, but you might be slightly off.
Okay. All right. Okay, so debt to income ratio for some of the programs.
So, and that goes by guidelines, normally by FHA or VA or conventional guidelines. The bank will usually set their own overlays on that as well. But the programs themselves, the TDHCA goes the highest one, which is that, whatever FHA says. So if FHA says 57, it's 57, which right now, usually it's 56.997 range for some reason. But Seth,
a random number.
It's a random number. I have no idea how they figured that 0.997 was going to do it, but the 998 is dead. But on the Seth and the Seth Gold Star, normally they like to keep it at 45%. There's even sometimes we get to 50%, but it's difficult to get past that point. I think TSACH or TSACH, I think goes to 55, and then City Grant uses its own weird ones. So there isn't really one on the lender side, but there's one there. And a lot of banks get confused because they'll think they'll run the numbers with the bank. The bank will have them at 55% debt ratio, and they're like, oh, sorry, you can't use City Grant. Even underwriters like, sorry, it says right here it has to be 45. Like, no, grandma lives there too. We just didn't put her on the loan, but they count. So that one's a little unique. But yeah, so those credit score requirements don't exist on the City Grant, and the debt ratio is a little odd on the City Grant. But the rest of them are usually 620, and usually in the 50s is the max.
Okay, cool. All right, let's see. Okay, so do you have to be a first-time home buyer to qualify?
Not on the Chenoa. And there's I believe one of the Seth programs, Seth Star, Gold Star, that you don't. So there's like 2 programs for sure that you don't, but TDHCA you definitely do, and with TSAT you do. So, but the good thing is there are ones that you don't have to be first time home buyer. So there are like 2 of them, but there are those options. You just can't own on at least one of those. The Chenoa lets you even own another property, but I think on the other one you can't own another property time you close. So you maybe sell and buy a new one. I know every now and then on TDHCA, I'll have somebody that owns a home thinking they can't do it, but it's like they own a home in some other city. They haven't lived in it for 3 years. Then they can move forward with them. So if they owned a home, but they didn't live in it as their primary residence for the last 3 years, they'll be considered a first-time home buyer.
Okay, cool. Yeah, and I was actually just going to ask that, like, let's clarify what a first-time home buyer is, because you can actually have owned a property before, owned a home before. It's just not living in it within the past 3 years, correct?
Exactly. And the weirdest part is you can own your mom's home, she can live in it, and you can still be a first-time home buyer. So there is some little tricks in there, too, that you can definitely move through. But, yeah, the hardest thing is just like USDA, most of them, you don't have to be a first-time home buyer when you use that program either, but you have to have sold your home usually. unless it's an investment. So,
Okay,
but yeah,
cool.
so there's some tricks in there, but there is the possibility of not being a first time home buyer.
Yeah. And you mentioned the USDA. I know we haven't really talked about that one. When I lived in South Carolina, I did it a little bit more because we did have some more rural areas. It's like within Corpus is pretty hard. I mean, I don't really know
Yeah, normally
too many
Corpus doesn't
areas
have it at
that
all, but
allow
all of
that.
Alice works, and Odom and Ingleside is a great one. There's a lot of places. I used to push it more, especially when I used to market Portland area, because a lot of my people outside of that area were close enough for the zero down. And the USDA is a great tool and a great product for people that want to do zero down, because you don't have to do any assistance programs necessarily, and you can have higher income. It's still capped at a certain amount, but it still allows that zero down with low mortgage insurance, and it's a great usual rate and lower cost deal. So I definitely think we should be doing more, and I'm sure we will once they start building more homes and doing more stuff out there, because like all of Rockport would qualify. I just think just because I'm mostly based here in Corpus, I don't do it as much.
Right.
I
Yeah.
probably only get a handful a year. But I really pushed for a few years, and if I would just probably have opened another office in Portland like I planned, I probably would have done more. But it's still great. I definitely, anytime someone builds, like almost all my Alice deals are almost always USDA, because
Yeah.
they're all going to be zero down, and then
Well,
in Rockport as well.
yeah. I mean, it's a good program. It's I know it takes a little bit longer.
Yeah, they've gotten really quick though. It used to take
But
a lot longer. Now it's been taking the last 4 I've done. It only took a week to get through USDA after we were done.
that's not bad at all. Yeah.
It's just a week longer, whatever my normal was. So if my normal was
Yeah.
taking me 45 days, and it was taking 52. But I would normally, if it was a good file, try to get it done in 30 days. We still have that issue of appraisers, so that can always be a deal.
I was gonna say, yeah, that seems to be the biggest
Yeah,
holdup.
they don't like to
We
work
need
in those
so many.
rural areas.
Yeah, it's like, I mean, they're like, oh, well, it's not due until this date. And then it's like a week later. And I'm like, okay, well, it was due a week ago. Like,
No, I'll see that with
hello?
like, hey, we're following up with the appraiser, and then another email next day, following up with the appraiser, we're following up. I was like, dude, where the heck is the appraiser? We've left numerous messages or whatever,
Yeah.
and then at some point in time, sorry, I was on vacation. I'm like, what the
Well,
heck? How do
thanks.
you
Why
just-
did you accept it then?
I know, it's so weird.
Yeah. Yeah.
It's an odd little thing there that I love the days when we got to pick our own appraisers. I see why we can't. And
Yeah, I know.
rules.
I was talking to somebody else about that, and they were like, "When could you do that?" I was like, "Well, I've been in real estate almost 20 years, so it was a while ago."
I'm pretty sure I could close things at least a week to 10 days early every loan if I could just pick my appraiser. I
Yeah,
can't guarantee he'd have the right value, but I definitely guarantee that this one or this one or this one could probably have gotten it done within 3-4 days if you were picking. But since
yeah,
nobody picks, and I get
yeah.
it,
You
you
can't pick
shouldn't.
anymore, so it's
Yeah, and you shouldn't, because you can lean it, and I'm pretty sure that that's also what was done quite a bit. So I get why you can't, but it is difficult since there's not really ability to put people in jail for not turning them in. So I don't
right.
know.
I know. Yeah, there's no repercussion for them, so it's like
No,
you can just
for me
be
to file a
waiting
complaint or
around all
whatever.
year.
Exactly.
Right. Normally not that long, but
No, and I've had some long ones sometimes.
Yeah. All right. Well, speaking of length, I think one of the next questions was, the next one was, do these programs have maximum amount of assistance? And then
So we know
do
they're
they
up to
take
400.
longer than a regular loan?
Okay, so yeah, normally they don't. The only thing we started doing lately is extending the closing cycle 2 days. So let's say you got a clear to close today, we would normally be able to close today. Okay, now if you have down payment assistance, if we would have gotten the clear to close today, we don't. We actually just finalize again with the down payment assistance, get all the paperwork in order for 48 hours, and then close. So normally a clear to close today would not come. It'd be a clear pending final down payment assistance paperwork, and we'd allow ourselves 48 hours to close. So we
Okay.
wouldn't be able to close till this Wednesday. So you may say there's a 2-day delay. Now the city grant one has a longer delay, because if you close, you have to close everything first and then wait 3 to 5 days to get the funds from them. And they explained how they can wire stuff and it'd be much faster, but that was like 5 years ago and it hasn't happened to where it's gone any faster. They
Well, we
wire.
were talking about Corpus, so
Yeah. Every time I call for speed or whatever, hey, we're doing more than just the down payment assistance. We've got a lot of things that we have to do. And like, I get that, but I don't think you understand how stressful this is the people need to be in. It's not that easy
Yeah.
of a job to just like wait in line and be like, oh
Right.
well.
Whenever you get to, it's fine. Yeah.
Yeah, no big deal. And then we'll all wait around. The seller doesn't care. They'll just keep paying the mortgage. It's fine. No
Yeah.
big
Right.
deal. Yeah, agents don't need to get paid. They don't need to survive as long as you are doing your best.
Yeah.
And I know you got to take Fridays off because it's the city. So take the
Right. Yeah. uh, all right. Let's see. What was some of our other questions? Does the house I buy have to meet certain criteria?
Typically it's got to meet the normal criteria. So if it's FHA, meet FHA criteria. The
Yeah.
only time that it has extra criteria is on the city grant. So
Yeah.
all the other programs, technically, if it wasn't written in the contract, the seller wouldn't even know you're using the other program, and there'd be no
Right.
extra appraisals or inspections or nothing. It would just be an add-on that shouldn't have any effect except for maybe a 2-day delay at closing, like we just talked about. The
Yeah.
city grant one, they actually do their own inspection, and they have their own requirements, and it can be a little bit more intense.
Yeah.
Again, those ones are a little bit harder to get through, but everything else in the other ones you wouldn't even know. Uh, Going back to the USDA one, the USDA one typically uses FHA add-on requirements if it's doing anything. So
Okay.
that'd be it. But yeah, for the most part, no big deal. You can add as many as you want. I think the only thing that is a judgment call is that some borrowers or lenders or agents may want to put that the contract is subject to getting approved for the down payment assistance. It's not required to be in there. Um, but it does make you look less likely to be a great loan. So I get why they probably wouldn't want to write that in, and it's not required. But if somebody doesn't have their down payment assistance, and then for some reason while doing the process, they don't qualify for the down payment assistance, either the debt ratio was off or their income was too high or something weird happened. I don't know what it would be that happens, but things happen that they can't get the assistance. One of the most important things is, let's say there's some tweaks in the income or assets along the process, few dollars here, a few dollars there, and now the underwriting system that we use doesn't like the risk factors anymore. First it said it was fine, now it's not fine.
Mm-hmm.
And when it's not fine, it's harder to get approved because you want what's called an approved eligible from your automated underwriting system, or AUS. And if it comes in as refer eligible, sometimes you can move forward at a lower price, but it's more difficult. And so if you can't fix that, you won't get down payment assistance. Well, if the reason they don't get the house is because they couldn't get the assistance, it's a viable reason, but it isn't actually in the contract they were even getting it. So I still probably would encourage people not to put it in there because I don't want them to be adversely affected. And a lot of my people, if they didn't get assistance, they would find another way maybe. And people get turned down for other reasons like appraisals or whatever. So there's a lot of good reasons for it. But that's probably the main thing I would say is that on the actual time frame doesn't matter, but the qualifications of it could affect whether someone gets a house or not. So
Yeah, I know it's kind of hard because a lot of people don't understand the programs, and so they automatically think if they see that, oh, you're using that program, either one, you're just a bad candidate for buying a house, or like, oh, it's going to take forever and it's not going to work, and so we're not even going to accept this offer. So it's like, it's always one of those things. And I guess, from a lender standpoint, you could probably say, hey, this person doesn't qualify because they're not getting this program, I would assume. And so then we could get them out of the contract with that, and they'd still
and I
be
think
able to get their money,
exactly,
earnest
if you
back.
were to really write it the best way, I would assume in your third-party financing, you would put that, especially if they're borrowing the down payment assistance, you would put that third-party financing higher than you would without it, which would be a way out. But yeah, again, if you put anything zero down payment assistance or whatever, could be a reason to get turned down, just because it is a higher risk factor that somebody doesn't have the money. And just so you know, half my people that do assistance have the money, but there's other things they'd rather use it for,
Right,
or
yeah, for
they
sure.
have to use it. I've had a couple people where to get the house they want, they had to pay off the car. Well, can't pay off the car and put down payment on the house. So it's either I don't get the house or whatever. So that's where we got to kind of make sure is that, yeah, they may look like they're higher risk because they're not putting money down, but they may be better risk than somebody that is putting money down if they lose their job or they have other things you wouldn't know. So.
Yeah, for sure. Yeah, I mean, as a lender, you're seeing the whole picture. Unfortunately, the sellers are not, so you never know.
Yeah, it's all a matter of base of who can see what picture. And then again, if the whole picture was always being able to be seen, some deals may never go through, and
Yeah,
sometimes I've had people that have had a really rough ride, but they've closed it out because they didn't give up. And I've had other people that barely had anything go wrong, but like sometimes I'll get people with great credit, but they just feel that because their credit's so good, they don't really need to provide all their financials. And why is this so much work? And they drag their feet, and the
yeah,
deals don't go so well. So you never know. Could be either.
yeah. Cool. Well, I think the last question you had pretty much already answered. What are some of the pros and cons of using those programs? And I think we pretty much started with
Yeah,
that.
mostly it's just like the
So,
rates and stuff like that. So obviously, if you can tell you got your credit scores, the fees, and a little bit of the cool features and the worst features you can kind of see on this diagram.
yeah,
Um, but that's the main thing in your max assistance kind of in there. So I think it pretty much will cover all those, and those things are subject to change at any given time. Not
yeah.
often, but they are. Um, you know,
Especially right now, I know a lot of lenders can't. I mean, obviously you still can, but a lot of lenders have, with the whole COVID going on, their credit score minimums have gone up a lot, and
you know,
just, they're
Well,
not.
and even my hard money, it was easy to do zero downs. Now it's much harder to do zero downs. Right now, they're being a little bit more strict, and they're starting to ask for 5% or 10% downs on the hard money stuff, which
Yeah,
they didn't used to. I hope they go back to the others, but it's still, I get it. Some skin in the game happens. Uh,
yeah,
and then my VA ones have been tightening up a little bit on the lower score options. So, but again, hopefully that'll slim back out. But
yeah.
since rates are kind of low right now, it's been like crazy busy. So whether they do zero down or not, or whether they get the best program or not, there's so many good programs to get in that doesn't make sense to rent if you can find something you like. So.
Oh yeah, for sure. I mean, interest rates are just
Oh,
crazy low right now.
oh
I
yeah,
mean,
you can
it's
save
like,
$100 or $200 a month over just a month ago. It's pretty crazy, depending on the
yeah,
house you're buying. So it's really
it's
cool.
awesome though. So, but yeah, definitely an awesome time to buy. Except for we have low inventory right now, so it's making it hard to actually finding stuff. But
Exactly. That's the hardest thing is the inventory, I would think. I think
yeah,
maybe not as many people that live in their houses want to put them on the market because they're in them. And maybe the
right,
COVID
yeah,
thing kind of messes with them. But B, there's only so many people. I thought we were going to have a really hard time because we were doing less of our lower credit score stuff, but we've been so busy because of rates. Things have been flying off that there's just not a chance to have enough inventory to do it, which is, I
yeah.
guess in a way good. It'll boost up pricing, I guess, which gets sellers more money, which gets more listings. I mean, there's benefits, but at some point it sucks having ready, willing, and able buyers, but nothing
They can't
they're
find
ready to buy.
anything.
Yeah,
Yeah,
exactly.
in our team, it's like we have probably at least like 5 buyers right now that just we're like we can't find anything for them, and it's like they're like twiddling their thumbs, like ready to go, let's
I
go. And I'm
know. And then
like,
some comes out today, and then by the end of the day, there's 4 offers on it, and you're like, oh wait, no, but
exactly, yeah,
well,
and I mean like we had one the other day where it was just like they were offer after offer, and it's just frustrating for them. It's like, oh, sorry.
for sure.
But yeah. Well, cool. Well, I think that was all the questions that we had, and I think you did a great job like going over everything. So,
Well, thank you so much for
um,
having me. If you come with any other questions, you want to do another meeting, I'd love to help anytime.
cool, awesome. Well, thank you, and I'm gonna share your info with everybody here again,
Awesome.
and then and then I'll send you the recording of this as well, and we'll be posting this everywhere. So. And
Wonderful.
hopefully you can help. We've had a lot of people interested, so hopefully you can help some of them out.
Hope so too. We got a lot of referrals, so I'm working on them today
Cool.
too. So I'll update you
Sounds
soon.
good. Appreciate
Thank
it.
you. Have a great day.
All right. Thanks. You too, Dante. Bye.